how to start investing. But before anything else, don't forget to like, share, and subscribe. If you're ready to start investing, you'll want to learn the basics of where and how to invest your money. Decide what to invest in and how much to invest by understanding the risks and potential rewards of different types of investments. What is the stock market? The stock market refers to the collection of markets and exchanges where stock buying and selling takes place. The terms stock market and stock exchange are used interchangeably. And even though it's called a stock market, other financial securities, such as exchange-traded funds, ETFs, corporate bonds, and derivatives based on stocks, commodities, currencies, and bonds, are also traded in the stock markets. There are multiple stock trading venues. The leading stock exchanges in the U.S. include the New York Stock Exchange, New York Stock Exchange, NASDAQ, and the CBOE Options Exchange. How do I invest? To buy stocks, you need to use a broker. This is a professional person or digital platform whose job it is to handle the transaction for you. For new investors, there are three basic categories of brokers: a full-service broker who manages your investment transactions and provides advice for a fee, an online discount broker that executes your transactions and provides advice depending on how much you have invested. Examples of this include Fidelity, TD Ameritrade, and Charles Schwab. A robo-advisor that executes your trades and can pick investments for you. Examples include Betterment, Wealthfront, and Schwab Intelligent Portfolios. What should I invest in? There's no right answer for everyone. Which securities you buy and how much you buy will depend on the amount of money that you have available for investing and how much risk you're willing to take in hopes of earning a higher return. Here are the most common securities to invest in, listed in descending order of risk. Stocks. A stock, also known as shares or equity, is a type of investment that signifies partial ownership in the issuing company. This entitles the stockholder to that proportion of the corporation's assets and earnings. Essentially, it's like owning a small piece of the company. Owning stock gives you the right to vote in shareholder meetings, receive dividends, which come from the company's profits, if and when they are distributed, and sell your shares to somebody else. The price of a stock fluctuates throughout the day and can depend on many factors, including the company's performance, the domestic economy, the global economy, the day's news, and more. Stocks can rise in value, fall in value, or even become worthless, making them more volatile and potentially riskier than many other types of investments. ETFs, an exchange-traded fund, or ETF, consists of a collection of securities, such as stocks, that often tracks an underlying index. Although ETFs can invest in any number of industry sectors or use various strategies, think of ETFs as a pie containing many different securities. When you buy shares of an ETF, you're buying a slice of the pie, which contains slivers of the securities inside. This lets you purchase many stocks at once, with the ease of only making one purchase, the ETF. In many ways, ETFs are similar to mutual funds. However, they are listed on exchanges, and ETF shares trade throughout the day just like ordinary stocks. Investing in ETFs is considered less risky than investing in individual stocks because there are many securities inside the ETF. If some of those securities fall in value, others may stay steady or rise in value. Mutual funds. A mutual fund is a type of investment consisting of a portfolio of stocks, bonds, or other securities. Mutual funds give small or individual investors access to diversified, often professionally managed portfolios at a low price. There are many categories of mutual funds, representing the kinds of securities in which they invest, their investment objectives, and the type of returns that they seek. Most employer-sponsored retirement plans invest in mutual funds. Investing in shares of a mutual fund is different from investing in shares of stock because a mutual fund owns many different stocks or other securities instead of just one holding. Unlike stocks or ETFs that trade at varying prices throughout the day, mutual fund redemptions tend to take place only at the end of each trading day, and at whatever share price the fund is worth at that moment. Similar to ETFs, mutual funds are considered less risky than stocks because of their diversification. Mutual funds charge annual fees, called expense ratios, and in some cases, commissions. Bonds are issued by companies, municipalities, states, and sovereign governments to finance projects and operations. When an investor buys a bond, they're effectively lending their money to the bond issuer with the promise of repayment plus interest. A bond's coupon rate is the interest rate that the investor will earn. A bond is referred to as a fixed income instrument because bonds traditionally have paid a fixed interest rate to investors, although some bonds pay variable interest rates. Bond prices inversely correlate with interest rates. When rates go up, bond prices fall, and vice versa. Bonds have maturity dates, which are the point in time when the principal amount must be paid back to the investor in full, or the issuer will risk default. Bonds are rated by how likely the issuer is to pay you back. Higher-rated bonds, known as investment-grade bonds, are viewed as safer and more stable. Such offerings are tied to publicly traded corporations and government entities that boast positive outlooks. Investment-grade bonds receive AAA to BBB ratings from Standard & Poor's and AA to Baa3 ratings from Moody's. Bonds with higher ratings will usually pay lower rates of interest than those with lower ratings. U.S. Treasury bonds are the most common AAA-rated bond securities. Are banks safe? Most bank accounts in the United States are insured by the Federal Deposit Insurance Corporation, FDIC, up to certain limits, currently defined as up to at least $250,000 per depositor per FDIC-insured bank, per ownership category. 5. If you have a great deal of money to put in the bank, you can make sure that it's all covered by opening multiple accounts. Is it safe to invest in the stock market? Stocks are inherently risky, some more than others, and you can lose money if their share prices fall. Brokerage accounts are insured by the Securities Investor Protection Corporation for up to $500,000 in securities and cash. However, that applies only if the brokerage firm fails and is unable to repay its customers. It does not cover normal investor losses. 6. What is the safest investment? U.S. Treasury securities, including bonds, bills, and notes, are backed by the U.S. government and generally considered the safest investments in the world. However, these kinds of investments tend to pay low rates of interest, so investors do face a risk that inflation may erode the purchasing power of their money over time. The bottom line: these topics are just the beginning of a financial education, but they cover the most important and frequently used products, tools, and tips for getting started. If you're ready to learn more, check out these additional resources from Investopedia.